Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, welcome once again, Art Jarvis. Hey, Taking Stock, episode number 14.
How about that?
It's great to have you with us.
Yeah, as always, glad to be here.
Sharing the insights on the world economy, the U.S. economy, the financial markets, and people's personal investing.
That's right.
That's it.
Right. Do our best as always.
Much appreciated. Well, people are starting to listen a little more. That's what we want to happen.
Mm-hmm.
If we want the people to, take stock with Art Jarvis, with a new episode every couple of weeks. So here we are with number 14, and since last we sat down, it's been 2 weeks. So we could start with what's going on the last 2 weeks, but I know you want to say something about the last 3 weeks or so.
Yeah, the last 3 weeks or so, as you said, our market's up about 15%. And I think, we spend a lot of time, and we've said it probably on most shows, that, about sticking with the plan. Watch the numbers, watch the trends, and unless something major is happening, you need to stick with the plan. And I think these last, 3 or 4 weeks, whatever it is, it has been the epitome of that. I mean, we made some money this year, we gave it all back, and we made some money, we gave it all back, and then all of a sudden here we are in the last few weeks, we've jumped up 15%. So, not several years ago, and I use the quote just all the time, I might not get it exactly correct, but if you miss the top 14 days in a year, you miss the vast majority of the up move in a market. So, this has proven to be true here recently.
Which that's the proof in the pudding for stick with the plan, because moving out or moving in gives you an opportunity to miss those 14 days you're talking about.
Right. I went out, I'm scared, I think the world's coming to an end and those kind of things. And in fairness to people, it's being perpetuated by what we read in the news and hear on TV and things like that. You keep getting these "the sky is falling" kind of reports, and we've been saying for 18 months, 2 years, that the rhetoric is not matching up with the numbers. We went through some bad times, but they have been improving, and I think and I still continue to say we need to focus on the fact that things are improving. So,
right. Well, the other thing, since we last recorded, the episode number 13 of Taking Stock, we've done a couple things over the last month. We had a little in between. About a week later, a quick update that we've shared on Loveland Beacon.
Right.
And so last week there was a quick update. And so repeat that news. In terms of last week, the update was, I'm supposed to remember that, aren't I?
Are we talking about Jerome Powell? Or are we
that's the second piece of the update. The first piece was that the word was out that, there's a pretty strong belief, as opposed to what Powell said 2 days later.
Yeah.
But there was a strong belief that the market is strengthening on the notion that there won't be increased rates from Powell. Now the turnaround.
Yeah.
You tell me.
Well, so you're right. So the rhetoric coming from some of our Fed governors and things like that is that they're starting to get the sense that we might not have to raise rates anymore. Okay, so fantastic, and that was received in a market that was already starting to recover. That kind of news was received very well, and it pushed the market up even further. The interesting thing is, and I understand what he's trying to do, but Fed Chairman Jerome Powell then comes out and says, basically what he said is, don't get ahead of yourselves. We may need to have more rate increases. But he's using what I call jawboning to get done with. If he can cause interest rates to move up a little bit and cool things off a little bit without actually having to formally raise rates, then he's still accomplished what he feels that he needs to accomplish. So, but also interesting is he made those comments, and the market seems like it's somewhat ignored him. It wasn't normally in the last 2 years. Every time he'd say that, the market would drop 5%. Well, it didn't seem to happen this time. But
well, you know how I love the analogies, and I always cross you up because I throw in my own analogy. Well, we're headed into the winter months here in the great Midwest of Ohio, of Cincinnati, where we could see some storms in the weather and some ice on the road. A slippery patch.
There you go.
So is Powell using the jawboning, as you said? We're tapping the brakes. There might be ice on the road ahead. It might be a little slippery. Slow down ahead of time. And are we ignoring him and going full speed ahead? But the question to you, in terms of, and you pay, this is what you do, and so I know you're paying attention and watching and forecasting. I mean, do you see that real slippery, icy patch ahead? Where we need to slow it down? I know you say, hey, a recession will happen, but I mean, you don't see it in the immediate future.
Honestly, at this moment in time, I'd be surprised if there was a recession in 2024.
Right.
So, and again, a lot of things have to happen. A lot of things will happen. So that opinion, number one, and what actually happens will continue to get tweaked. Has been on, as I always say, got to keep an eye on the consumer. Well, the consumer's still there. I mean, the one thing that's interesting to me is if you look back, 8 to 10 weeks ago, we were the thing that caused us to lose all the returns that we had generated in 2023 was that all of a sudden interest rates went up and the 10-year Treasury was jumped up to 5%. So we're hitting that, which number one is that's a pretty big jump, and number two, 5% is a psychological level. So it's people were watching that 5% really hard, and then that's how we gave back all our returns. Well, here we are 8 to 10 weeks later, and the 10-year Treasury's down to 4.25%. Well, that's a big move. That's a big move up to 5%, and that's a big move right back to 4.25%. So we are, as investors and traders and things like that, we're getting jerked around a lot, by what is going on in the markets, but. Yeah.
Well, I love your term. I think you've used it a couple times, in recent episodes. But the ridiculousness,
so, yeah.
which is which other people might just say, hey, riding the roller coaster a little bit. But I know some things that contributed is what you were referring to as the ridiculousness, and part of that is the reference to Powell and the jawboning about he keeps warning us about we're not done with the interest rates yet.
Jerome Powell wants 2% inflation.
Right.
So now we've gone from whatever it was, 9 or 10% inflation down to 3% inflation now. So that's a good thing. But he still wants to take it from 3 to 2. So he is still using his tools to try to accomplish that. But you talk about a slippery slope or ice on the road and things like that. He needs to be very careful from his standpoint that he doesn't slam this car into a tree, right? If that makes sense. All of a sudden this economy just, he took it just a little bit too far. And, and that's the goal. We always talk about this soft landing. You're trying to get things back down to where you want to be, but you don't want to trash the economy at the same time. That's the soft landing. That's what he has to be very careful with. They've done a good job of backing things back down and keeping the economy going, but don't, I always use the spigot. You're turning the spigot and you're turning it down a little bit. Just make sure you don't turn the spigot all the way off, right?
I got you. Here we go with the analogies again.
Yeah, sorry. Yeah, we'll just.
No, that's a good one. I like that.
Yeah.
But and I appreciate you stuck with my slippery road, and that Jerome Powell needs to be careful not to slam on the brakes and slide across the ice into that tree in the curve.
Yeah.
I got you.
And
That's
it is
good.
very much. It actually is a pretty good analogy because if you slam on the brakes and you're sliding on the ice, you kind of have no control, right? So if you take things to a point a little too far, you start to lose some of that control that you had. So we're in that point now where over the last 2 years, especially in 2022, they made some big interest rates adjustments, 0.75 of a point. Now we're in that point where you're tweaking things. You're tapping. You're not stepping on the brake. You're just tapping, right? And they got to be, again, he's got to be careful about how he does it.
Well, it's amazing to me because I'm not well versed in this. It's not my area of expertise. But understanding that, why do you want to slow the economy? Well, you do. You don't want to just let it run off out of control and then find a tough curve or whatever, sticking with that road analogy and the slippery ice and things like that. But, I mean, to me, it's fascinating to learn about, because I don't think about it. It's not my area of expertise. Right. And I am, I'm probably your perfect customer because I like to just stick with the plan and let it ride. And it's good to be in a position where I don't have to freak out every time the market moves up or down. And I guess that's the thing that you're trying to get the message to clients or just not clients of your own, but investors all over the place, is that whole thing we keep saying, stick to the plan and, to get them to be able to, relax and stay comfortable and confident with what's happening and not go into panic-driven selling or buying. It's about trying to stay comfortable.
People, again, with the market and the way the business is different than what it was 35, 36 years ago, right? I mean, the rate of information that you receive, the amount of information you receive on a daily or weekly basis is a lot. But it seems to me a lot of it has been, you watch the headlines, and the headlines are in a way that it sensationalizes it and makes it more than what it is. Okay, so there's a reason, for hopefully over a period of 36, 37 years now, I've built up a little trust with my clients, right? So in general, but you do, there is a oh my gosh, I heard this or I read this, and then there's a phone call, and then you kind of back them back down again. Right? Here's how we're looking at this, and there is volatility depending on how you set up the portfolios and things like that. There is going to be volatility, but the question is we're trying to get from point A to point B. So what's the best way to get to point A to point B? And right now, I would say the road from point A to point B is not that bad. Okay, it's not. It's smoothed out a little bit especially compared to the last 2 or 3 years where we were off-roading for a couple of years, right? But
and then off the road and on a roller coaster even, so
it's been. I mean, there's some bumpy times, but and I'm not sure what the word is, but I think our people in the world could be better served without other people out there kind of sensationalizing things, And a good example is, let's say, an employment report. They were looking for the employment numbers to go up $200,000 this month, or 200,000 jobs this month. Well, it only went up 177,000 jobs, so everybody's upset. We missed expectations. It's showing that the economy's not doing as well as we hoped it would be. And I was like, they're not that good at it, right? If I'll take 177,000 jobs created any month. I mean, that's pretty close to what I would consider a normal month in the U.S. economy. But the report comes out it's a big miss, right? We missed it, and it's not, and all those things. So,
well, it's how the information is presented.
That's exactly right.
I mean, when I was saying a minute ago, and it ultimately leads to a question, Art, about getting the investors to sort of stay calm, to stick with their plan, and not do things driven by panic or driven by that information being reported the way it's being reported. If somebody said, without you knowing anything, hey, we had 177,000 jobs gained this past month, whoever you are out there listening, if somebody told you that, I know what you'd say, so I'm not really saying this to you, Art, but it's like if somebody told you 177,000 job gains in the employment report over the last month, you'd think, wow.
Yeah.
But instead, it's presented as, well, we were projecting for 200,000 and we missed the mark.
Missed the expectations.
Yeah. Well, that's a tough thing. So the question ultimately that I'm getting to is this: would you say that it's important for people, it's important, it has a positive impact on the market when the people can in fact stay calm.
Oh, very much so. Yeah, I mean, if people are calm, you're not having all this selling pressure and things like that. So it does lower the volatility of the market. I mean, if you look from 2000, just call it 2010 to 2020, in general, it was a U.S. stock-driven market, and in general, we pretty much went up.
Right.
You know, and
now, what was the time frame of that again?
Just say 2000. So we came out of the Great Recession.
Right.
So it came out. So that would really be like April of 2009. But from that time frame, right up to the pandemic, at the beginning of 2020. Beginning of 2020, this economy
so
was
almost
rocking
a full 10-year run plus.
Sure.
You know.
And we had better than normal returns on average for that 10-year period. So we were, in my opinion, we were way ahead of the game for that 10 years. We just kind of chugged along. Don't get me wrong, there was a couple speed bumps in there and things like that, but nothing like we've had for the last 3 years. So, you know, you that was a nice period. There was some volatility, but it was nowhere near the volatility that we've seen over the last 2 or 3 years. So if people can not overreact or even react to some of the stuff they're hearing or seeing, then yeah, that lowers the volatility in the market and it carries forward. It's kind of like a wave, right? And if I'm not panicking here, that doesn't cause panic down the beach either. You know, So then, another thing, and you kind of anticipated because you just gave us that number, that 177,000 in terms of the employment report, and I was just getting ready to say, share a little bit because you touched on numbers. So share a little bit of numbers. People don't get to see us as we sit here and record taking stock. We do it as an audio, not a video, so you don't get to see Art and Chuck. You're probably very happy. It's a good thing, right?
Maybe I was going to say that might be a good thing, at least to not have to see Chuck. But one of the things for listeners right now, you don't get to see Art while we're having this conversation and talking about things. He's looking at numbers. Sometimes he's not at this very moment, but frequently while we talk, Art's looking at numbers. So that's why I say share a little bit of the numbers like right now that you've said. You know, I know you were talking about the 15% that increase over the last several weeks. What's today looking at as we sit here on Tuesday, December the 5th, headed into the Christmas, holiday season, starting to wind down 2023 and jump forward to 2024. What are the numbers looking like? And
yeah, well, I think the biggest. I mean, we've talked about inflation, we've talked about employment. All those numbers have improved substantially. The GDP is substantially better. Gross domestic product, what our economy is doing, is substantially better than what we were told was going to be this year. I mean, at one point we were talking about 0.1% increase in our economy. Well, the last one was 2.9. So that's how much further ahead we are than what the rhetoric was a year ago. But yeah, so the employment numbers, the consumer numbers are looking good. We just went through Thanksgiving, then we got Black Friday and Cyber Monday and Giving Tuesday and all those things. Those numbers all came out very nice. I mean, those were some big numbers, so they were better than expected. So that's good. I think for me, though, the biggest thing, which has the biggest impact on how I'm looking for things 6, 12, 18 months forward is, we're at that 4.25% on the 10-year. So what that allows our potential, our expectations for the market going forward to be a little higher. If you're looking at a price-to-earnings ratio, let's say the market's at 18 times earnings right now. But if you continue to lower those interest rates, which is where we were for a decade at, very low interest rates, so we were able to maintain a higher PE ratio or a higher market multiple. So if we're continuing to get decent earnings projections, but we also have the potential to multiply that by a bigger number, that's given us a potential going forward for still continued positive returns. That's the number side of the equation, and then you want to start looking at things like we're heading into an election. So typically,
I wasn't going to bring that up.
Well, we'll just go with the fact that typically an election year is a good year. Okay.
Well, you know what? I say that not jokingly at all. I wasn't going to bring that up. I thought about it.
Yeah.
I didn't, Art, because we've talked about what do elections really do to the economy, at the end of the day, it's about a zero.
Yeah, it's a push, in my opinion. Yeah.
Well, so a slight push generally after an election's held.
Yeah, and again, I've described it this way before. The economy is a great big super tanker out in the middle of the ocean, right? It takes a long time for that to turn and go a different direction, And sometimes we treat this like a jet ski. We're turning on a dime and going the other way. That's not how it works. So yeah, you go into election and there's a lot of promises being made and things like that, but the immediate impact on the economy is not that great. And the only thing it could possibly do is if everybody's feeling fantastic about what they think is going to be coming down the pike, then maybe they go out and spend some more money or something like that. Maybe they've made some of those discretionary purchases maybe they might not have made or something like that. So, and then honestly, the other thing is we always talk about a Santa Claus rally. So you head into December, and will Santa Claus show up and give us a little positivity in the markets? And the third thing I was actually thinking about this morning is as humans or whatever, we tend to look at things in a calendar year perspective.
Right.
So here we are. We're coming up on the end of 2023, and now all of a sudden something magical is going to happen or not going to happen. And we switch over to January 2024. It's a brand new year, And for me, that's not how things work.
It's just the next month.
It's just the next month, and I continue to look at things from a long-term perspective. I don't care if it's how much of it is in 2023 or how much of it's in 2024. It's still, if I'm looking at a 12-month period, I'm looking at a 12-month period. It doesn't matter what year is on the end of that period. So.
Well, if I'm listening and hearing what I think I'm hearing from Art Jarvis is all the indicators that you're looking at to project that 6, 12, 18 months, because you have to look ahead, to serve your clients best. And for investors, whoever's serving you, that's what has to happen. So if I'm hearing you correctly, what Art Jarvis is saying is all those economic indicators are headed in the right direction right now.
At this moment in time, that is exactly correct.
So what without going into what they all are doing, but what are the key economic indicators when you're trying to forecast and project what are the best places for investors to have their money, or what is the best thing for
their planet? You mean just which ones do I look at, you mean?
Yeah, right, yeah.
Yeah, again, gross domestic product, inflation, earnings projections.
So earnings projections
numbers
are up, inflation is down, gross domestic product is up.
Yep.
I almost couldn't spit that one out. But yeah, that was up almost 3% higher than what they expected, right?
Yeah. Well, yeah. It's way higher than what was expected a year ago. But it's still even better. It came out better than expected, even when they announced it.
Yeah. So then I interrupted you, and besides those three, what are you looking at?
Those are the biggies. You start looking at, there's some coincident indicators and things like that. There's a whole bunch of different consumer numbers that you can look at and things like that. But the gist of it is the consumer in it, or is the consumer backing out? So,
Right.
That's what, for me, besides interest rates and earnings numbers, it's keep an eye on the consumer, because inflation and employment and all that are also drivers for the consumer, right? So but really it's the consumer. If the consumer is 70% of gross domestic product, 70% of the growth in the economy, you better keep a close eye on them. So.
Yeah. Well, I'm going to go against your grain slightly.
Uh-oh.
Right now, just slightly. You'll figure it out here in a second.
Okay.
So he has talked a lot. Way more than you've wanted him to, Jerome Powell, which has led us to talk a lot about Jerome Powell in recent episodes of Taking Stock. And so going against your grain is this part. We just said that January is another month. Mm-hmm. It's not a new year. Well, it is a new year.
Sure.
So going against your grain, I'm going to put you on the spot.
Okay. Here we
I
go.
hope you're ready.
Yeah.
All the talk that he's putting out there, and all our talk, and you're, looking at what Jerome Powell's doing or not doing. How do you? What's your report card for Jerome Powell as 2023 comes?
Well, since you're asking me,
I'd want your honest opinion.
I'm not going to give him a grade, but how about if we go with not impressed? I think Jerome Powell and the Fed did well, I'll be real straightforward. I think they did a terrible job of managing inflation. They started raising interest rates in whatever it was, March of, let me make sure, 2022?
Right.
They should have started raising interest rates back in 2021. They should have been raising interest rates 6 months. We pumped $6 to $7 trillion into this economy, and I don't care what economy you're in, I don't care what economics class you take. You pump that much money into an economy, you're going to have an inflation problem. And they should have started backing down on those interest rates and raising those interest rates to try to back down the economy a little bit much sooner than what they did. And the sad part about that, and I say this all the time, is we've had some bad years in the markets in the past. Last year, the bonds were down 18% in 2022. The stock market was down 20-something percent in 2022. International stocks were down 20% in 2022. The problem with that for me is that was unnecessary, and that's what bothers me. So I can, if we go into a bad economy and we get ahead of ourselves and we need to back it down, I most certainly can understand that. But in my opinion, 2022 and losing 20% was completely unnecessary. So the other thing, and maybe I'll get a call from him. We'll see. But the other thing is when you look at a Ben Bernanke or Greenspan.
Yeah.
They were the masters of, I'm not even sure what the word is, of the gab. They could talk. Yeah. They would talk for 2 hours, and then people spent 2 weeks trying to figure out what they said, right? My problem with Jerome Powell right now is that he has this sky is falling kind of delivery on what he's saying. He's kind of just punching you in the nose with it, like, you know what, I'm going to do this, and if it takes the economy into a recession, I don't care. I want 2% inflation. And again, I'm simplifying things a little bit.
Right.
But him compared to some of the ones in the past, again, I'm just not impressed. I think we could do better.
Well, I was going to tease you, so well, don't hold back.
Well, I know, and I don't think I did. I mean, I talk to clients about this all the time. It's like, and especially about last year. Just what aggravates me is last year, what 2022 was unnecessary. I mean, could the market been down? Most certainly, but should it have been down 20-something%? No way.
Well, Art, I think you said it well. I appreciate you're not backing off because I don't know that was your favorite question to hear from me. How do you grade Jerome Powell right now? But I think you did it well, and you answered a question without me asking it, which is why is it that you think he should have done this earlier, and what was the negative impact it had? So, thanks again for joining us today. My pleasure. Always enjoy it. I really do. It's good to have you. Appreciate people listening. We'll be back. Today is the 5th of December. We'll be back for episode number 15 of Taking Stock on the 19th of December. Yeah. All right, looking forward to it. We'll see how much Christmas spirit we're in on that day. Well, for now, I'll say Merry Christmas. There you go. Thanks, Art. Right. Thanks, Chuck. Appreciate it. Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.